Okay, so we've got Investor Hot Seat with Kaan Akin here. We're going to ask you some questions. Well, I'm going to ask you some questions about investment that are on the tips of every founder's tongues, and yeah, just sort of getting to understand the psychology of what makes an investor tick, what you're looking for, and all those sort of specific criteria. But first of all, I'd love for you to just do a little quick intro about who you are, what sort of things you like to invest in, and just sort of introduce yourself quickly.
Sure. Thank you, David, for having me. I'm Kaan. I'm managing partner at Tenity. At Tenity, we invest in early stage fintechs. This is our third fund. Personally, I've been an angel investor as well. I think I've invested in roughly 20 companies. Not some of them are with us anymore, but this is a learning. So at Tenity, again, we are quite interested in fintech. We are investing in Europe and Asia Pacific, and hopefully we will extend to new regions as well. Uh, and I'm super happy to answer like whatever questions that you have for me.
Yeah, absolutely. Well, I think that the main thing that I kind of help founders with, or the thing that a lot of people struggle with, is actually making the connection with you and the very best way to connect to investors like yourself. So, can you give any advice on how that should look, what that initial approach should look like, what's the best platform, what sort of messages work, what doesn't work, and just any advice you can give on that side of things, the connection.
Sure. I mean, I think there are plenty of different types of investors around there. Like there are some investors, really angel investors, which invest maybe like no traction. And then you might have your pre-seed or seed investors. Basically, they want to see some kind of market fit. And then you have your later stage investors. Basically, they really look for some kind of profitability, scalability, like a well set up team. So it would be all different to get some kind of attention. What I would suggest people to do is like generally the idea to invest in a company takes some time. So you need to start your relationship as soon as possible. So you identify your potential investors and you don't ask for the money the first time that you get to meet them. So you identify those people. How do you do it is basically you check like companies like yourselves who invested in the early stage and you see like David and Kaan did. So basically what you can do is what Kaan does. Sometimes investors does like office hours. We just did a community event at our office in London. So some potential startups came there too and maybe just stalk a little bit. What are my interests? And try to be a close person because most of the time we want to see that traction, not just in the business, but in your life. So today you come to me saying that, hey man, this is what I've been building. If you can give me feedback, I would really appreciate it. I tend to find time for a feedback as much as I can. Obviously, I cannot return the favor, but I try my best to do it. And then you update me. You say that, hey, Khan, you remember you told me that this should be a little bit different. And I tried this, and actually, our demo customers had a good feedback on it. So, this actually shows good traction. I love founders with grit. Then it builds on a relationship. I think for the early stages, that's the most important thing. And you keep that relationship.
Okay, so what you're saying is the first thing I'm guessing is to make sure that you are the right investor for them. So they've done their research on you. And if that's the case, then you kind of welcome an in-person approach. But I mean, a lot of founders, just can't do the in-person stuff. So what if it was like an online approach? Would they having researched you? Let's look at the ways they can research you, and then how to connect with you, and then they're sort of you saying the best way is to actually ask for advice even before you've got the pitch deck ready, and it's really sort of quite early.
I think the first thing they need to ask is advice because, like,
Okay.
for investors, obviously, we receive so many investment proposals. They share
Yeah.
their opportunities every day. So I don't think that there is a day that I've never received anyone sending me their like opportunistic deck. But if you ask for advice, obviously, you are trying to get some kind of feedback. Obviously, I know that you want my money and which is
Mm.
normal because this is what I do. So there is nothing wrong with it. So it's not like you trying to scam me with like different hooks. I just want to understand like if I'm going to be the smart money or the money, or like am I a part of like a campaign which send like 200 people with the same thing? You can see it, you can understand it, that's
Yeah.
fine. And then you kind of like do your job. Obviously, in person helps a lot, but there's not a big problem. So all of us are quite digital, and I like
Yeah.
to do it like over emails, over like Zooms or like Teams. I don't mind, uh, but please do your work because I need to see that my time is well received. It's not about the opportunity, it's not just the money, but when I'm going to spend my half an hour, I just want to make sure that that person is the one who deserves the most and I can help that person the most. So maybe later on it would be the money as well.
And I think that's is that sort of a common theme with like on the angel side. I'm guessing when you go more to VC, it's a little bit less helpful, is it? Or how would you sort of see that relationship changing?
I mean, honestly, like I do have a lot of my friends who are investing. Like we just sometimes talk about like how we decide on investing in a company. In many of those cases, we know the founders for a while and they've been delivering what they told us. Like maybe on an angel level, they were saying that, oh, I'm going to deploy the app and I'm going to have 10,000 users. And they did. In the Series A, they're just saying that, hey, man, we just conquered like the London market. Now we are going to do rest of the UK, and you see them doing it. So that's what I'm saying in terms of like the traction and knowing each other. Because think about
Yeah.
this: everybody sends you a unicorn deck. I mean, I to this day never seen an opportunity less than 500 millions worth, like literally. And I think to our programs, accelerator programs included, I think I received like 35,000 startups all around the world. And every one of them said like their company is going to be a half a billion in 8 to 10 years. And only two did.
Yeah.
Maybe I missed like one or two, but the statistics are there. So it's not going to be an easy task. So we just need something to hold on to it. Obviously, there
Mm.
will be some kind of like random things, but most of the founders go to their investors either directly by knowing them or asking people like me or other investors. So that is quite common too. So if I invested or didn't invest and it's not in my stage, I'm super happy to send it to my friends. And they know if I'm sending someone, I kind of did the pre-screening. So that's why you need to have this kind of relationship so people can actually would like to help you out.
Okay. And with that initial, if they do approach you sort of quite early, do they still send a pitch deck, or is it more sort of asking questions you sort of welcome at that first stage?
Yeah. I think in the earlier stages, like pitch deck is fine, but a lot of people don't rely on it because most of the thing that you are saying is like nothing, like you are saying that, oh, there is a market, there will be our customers. So there's nothing to really show it. Like it's more like storytelling, which is a great thing, great tool to use it. On the seat level, I think pitch deck is much more important because now you are serving clients and your one part of your job is going to be storytelling as well and showing what you have, kind of like reporting. So it shows more things. And I think it's when you are going to like Series A, obviously you talk about your business, but then most of the things are in Excel files. It's hardcore numbers rather than the pitch deck. So pitch deck is always nice, but again, just don't make me work for you, even if we don't know each other. Just tell me what is happening. And in that case, what is the problem? And why do you think that this is a problem? And why do you have some kind of an edge to sort it out? Like, this is kind of the
Yeah.
core of most of the startups. You realize there's a problem, but it might be a problem that you think that is a problem. If you show me why this is a real problem. You can say that I've been working in banking and that was a issue at Barclays and we were having this 1 million customers and we didn't sort it out. And I decided to do it myself because I know the cybersecurity quite well. That intrigues me. And then we can talk. And funny thing is, roughly 60% of the early stage founders pivot anyway. So
Yeah.
that's why I don't really care about your presentation because in like 6 to 18 months, it's going to be a different business if you like it or not.
Okay. And that sort of business evolution, you actually kind of nurture that and you encourage that.
Yeah, I mean, this
Mm.
is a fact. If you don't want to nurture it, you are going to be malnourished. This is the reality of the things. Like even the seed funds, like one of my friends, E2 VC, Emerging Europe. So Ennis actually published the statistics about their companies, and they tend to put like seed capital, 500,000 to million. I think the number is a little bit lower, but still like more than 30% of the companies that they invested had pivot, which is normal. Like because we want to understand the market. We don't want to sell whatever have we have in our minds. So that would be the case. So we like it.
Yeah. What about if a company comes to you that has kind of done all that work? They've actually gone to market. They've got a lot of evidence. They've already maybe adapted themselves to the market, and then they're kind of a little bit further along. How do you sort of deal with that? And what sort of evidence do you look for that that has been successful?
I think the best evidence is what their customers are saying. If it's a B2B model, it's a little bit hard to get the feedback, but you tend to find those kind of guys. Like you can ask the company, hey, can you just introduce me to one of your like customers in like Barclays, HSBC, whatever, just to talk about like the product. If they say it's incredible, that's perfect. If it's B2C, it's quite easier, because then you see like if even like 10% of their current customers, if they've been using this for 12 months, you know that this is kind of an important thing for those people. The only question then, how many of those people in the market? So how many of that fan base could be enlarged to? So if a company is doing well on the customer's regard, I think they would do really well in the commercially. Um, and again, it goes differently in terms of the stage of the company. And what you said is hopefully looking for a seed capital. And in seed capital, what you tend to see is like you have your product market fit, hence happy customers in a way.
Yep.
Basically, with that money, you try to find a scalable way to increase your base at the minimum effort. So,
Yeah. Okay. But like, am I right in saying that you kind of focus, you're quite interested in the idea
yeah.
phase? You're sort of pre-seed, pre-revenue
I mean,
is where you get
I
involved.
wouldn't call it idea. Like, I
Mm.
rarely invest in a company which doesn't have a traction, but
Yeah.
traction doesn't mean that you have a market fit. This is
Yeah.
what I'm saying. Like, you can get some money as a company, and your product could be like one-off. Like, you can always you can sell really bad stuff to people. So, a company making money doesn't show a market fit. It shows like at least that person can sell stuff.
Yeah.
So I would say like early stage means that you have your whatever you are doing and you have traction still. So most of the companies that we invest currently, the valuation is 2 million and 2 million is like pre-seed. And I think like 95% of the companies that we invest, when we invested, they already had established companies and revenues. So I wouldn't call them idea.
How do you know that that 2 million valuation is correct? And how do you
But you wouldn't.
push,
That's
how do
the
you push
point.
on that?
No, no,
Yeah.
no. So,
Well, what do you look for, like in terms of
sure.
valuations and believability and evaluation?
I mean, how we invested for a while, I mean, still to this day, we have our program to help people out. So it's an accelerator model, and you cannot do in individual valuations. And to be fair, after seeing like hundreds, maybe closer to thousands of rounds, it's nonsense. There is like early stage investing valuation. There is no valuation. So sometimes what happens is some company comes and says like, oh, you know what? I talked to this company and they made a valuation of my company and my company seems to be 4 billion. So 4 million. And at the end, I'm the only person happy to write a check with 2 million valuation. So what I say is, if you want, you can have an advice and no investment, or if you want, you can have my check with the valuation that I see fit. Because I'm not saying that I'm an asshole, like on a capitalistic way, but market decides. If your company is 4 million, then you will have more people saying that, yes, here's my money, take it. If you don't have those people, it shows something. What it
So,
shows, your company is not 4 million, for example.
so what's the calculation and the due diligence process that you go to sort of understand what a company's worth?
In early stages, I would say this is not a real task, to be honest. Like you can definitely do so many different ways, but the due diligence, generally what you tend to do is like you do due diligence on the founders. You do like the on the
Okay.
banking account and the registration. This is like a more KYC rather than the due diligence itself. Then you try to understand like the code base, what kind of technologies they are using, because in some cases people kind of like bring this uh, there's nothing wrong using like open software, but if they don't disclose it, that's a problem because it shows that the
Okay.
founders are lying. So, in very early stages, I think the due diligence is what it is. And when you have the traction, obviously you would like to see the invoices and the bank in time and what happened. Like it is really hard to do more than this if it's a
Yeah.
scalable company. Obviously, if you are buying a grocery store, then the due diligence would be quite different because there are so many tractions and the valuation is also a little bit different too. But early stage valuation is whoever would like to give that money, I would say.
Okay. So a couple of things I'd like to drill into there then. So, um, you talked about founder due diligence.
Yeah.
So, what are the qualities you look for in your founders or your sort of C-suite or the kind of the founder and co-founder team? What do you like specifically dig into there?
I mean, ideally, the founders should be complementary.
Mhm.
Because like in most of the businesses, you need some kind of core skills, right? You need some kind of a CTO person who understands the problem space. If it's like cybersecurity, who needs to understand like the technical aspects of it, or it might be someone who has the commercial skills, either really going there and selling stuff, or maybe more on a marketing level, attracting potential clients to the website and maybe someone with like everything just a little bit to be the CEO who generally does the fundraising because that's another like important part of it too. Depending on what kind of a company you are, you might have different skill sets on different levels. There are some SaaS companies, for example, it's just marketing and technicals. You don't need anything else. If you can do a nice SaaS product, you can land a lot of companies in and if you can convert them, you're happy, like you don't really need salespeople, or maybe you don't even need to fundraise even in that level because they're super happy to do it. So one thing is like complementary skill set.
Mhm.
Ideally, it should be more than one person, but it's also quite tough. The second thing is like how much past do those guys share together? Because we also see a lot of co-founder divorces in founder
Yeah.
space. And we know that is a fact. Like 20%, I think that was the last thing of the
Mm.
portfolio companies lose one or more co-founders along the way, which is normal. This is life. But that also traction, if they spend like 3 years before they worked in different places, they're friends from like college, it shows you some kind of solidarity. So they know they're like bad stuff too, because sometimes people are too much, right? Like if under stress, I become really a pain in the ass, maybe you wouldn't care. But a few of my friends who knows me for 10 years, they will know that Kaan will be okay tomorrow. Let's leave him alone. But
Yeah.
so this two thing in the founding team is super, super important. But again, like I would love to see the answer to why you are solving this problem. If it's a SaaS product, if it's a cybersecurity product, you need to tell me why this group of people are more relevant than any other people in the market. Because at the end, whatever you do, the competition is there. It's really, really hard to create a moat of around a really early stage company, right? So if we want to make sure that we have the better odds, I hope you have some relevancy to the problem space. Maybe you spend some time, maybe you know people that other people don't know, maybe you have a license, something like that.
So any kind of competitive advantage, anything that all those sort of credibility signals. What about on a on a personal level, personal achievements or anything like that? Is there anything like that that really stands out? That you think, oh wow, look at that. That could be a really significant factor.
Yeah, I don't know. Maybe a bad signal in a way.
Really?
Yeah, I
Okay.
mean, no, the
What would be
thing
a
is,
bad signal?
no, obviously, like there would be some good signals for sure, but
Yeah.
we dealt with like a lot of academically superior people,
Yeah.
and they were really tough founders. I mean, not tough because they deserve it. They are pain in the ass type of founders. I mean, I don't really think about the companies that I invested, but we also run a lot of open innovation programs with companies like Visa, HSBC. So we help those early stage companies to create more traction with the corporate partners that we have. So that kind of things, it might be super relevant if you are on a deep tech space. If you are doing cybersecurity, if you are doing like cryptology, and if you have a grant or like a research dedicated to you, that's perfect. That shows significant stuff. But in some cases, if you are doing a commercial product, let's say in medical space, and you are a well-regarded doctor, obviously, it looks like a plus, but you know what? Those kind of people don't really take feedback well. And startups is not a place for like we always do customer development. You always get feedback from your customers, your investors. You need to be sharp listening to people. And some of
Yeah.
those well-educated, well-established people has all reason to think that they are the best already, and it becomes really tiring and they
So
don't grow. It should be growth mindset. If they
yeah.
are smart, established, and they have the growth mindset, definitely a plus. But otherwise, if they're not coachable, I don't really see any of those kind of founders succeed. They can
How
do a product, but not really a good company.
Yeah, and how do you sort of screen out those people? Is it through an interview process? Is it like a gut feeling you get? Is it even how they write their pitch decks? I mean, how do you know?
Yeah, I think so. Like it's generally the interviews that we have. Like obviously you don't do the interview. So basically how the pitching process happens is like basically it starts with like a cold reach out, right? Somebody writes you on
Mhm.
LinkedIn or like
Yep.
probably you have a link where people upload their decks and what they are kind of like looking for. Anyway, that's the first thing, and that is for getting the attention. And then someone, probably not me, but investment managers of ours, portfolio managers, does some kind of a screening just to understand if it makes sense. And if that founder makes sense or the startup looks promising, then we have a meeting. And in that meeting, obviously they pitch whatever they have, but the Q&A session is much more important than whatever they are doing because, as I told you, things will change. Probably the team will change, the
Yep.
product will change. So that questions, generally we don't have answers to the questions that we are asking. It's just how they take it, you know?
Okay.
If they show this kind of versatility, understanding, and show some kind of grit, that's good enough. And most of the time, I mean, there are so many founders who failed, which I backed, and I'm super proud, versus some of the companies who are making, and I don't think they are going to do much better, but those guys did much better. Probably their next startup is going to be more valuable. So,
Hmm.
yeah.
So, do you deliberately try and push a little bit and try and rattle people in that Q&A, but to sort of see what's underneath kind of thing.
Yeah, yeah, yeah. I mean, like obviously you don't really do it to the walls. You kind of do it like just to see where it goes. But again, like being an investor is partnership. It's not like buying an ETF. And trust me, buying an ETF is super nice because you buy it today. If you want to sell it, it's fine, maybe less than the venture return, obviously, but you don't have a call from the ETF provider saying that, hey man, we are going to run out of money, or do an introduction, or sometimes even like someone swearing, saying that, hey, I thought that you supposed to introduce us to other investors, blah, 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 because it's an intense process. So when you need to basically decide if you want to take the calls from that person for 10 years to come, in a good day, in a bad day. So,
Right.
because I mean, I know that everybody has different reasons to become investor, but I still want to enjoy my life. So if I see that person as a pain in the ass, I'd rather not do business
Yeah.
because it is not worth any money, to be honest.
Okay. Okay. Cool. That's great advice. It's interesting you say about a 10-year relationship. I don't think people sort of realize how how long that can be. That is really interesting. Now, one question that I'm asking a lot of investors, and it's really a crucial thing, and it's something that I try and sort of coach into my founder clients, is about when obviously the founders want to get the money in as quickly as possible, but
Yeah.
I'm always saying it's really about what the investor sees as who they want to urgently deploy their money, or not urgently, or who they want to deploy their money in first, or what signals cause the investor to go, this is the one I want to invest in now, and not this one, and not this one. So I really want to sort of dig into those factors. What makes you want to jump on something now?
I mean, let's think about it. Like, we are in the discussion. You're a founder, I'm the investor. So if you need my money, that's good. So the transaction is going to happen. Let's assume that.
Yep,
And I have my money. It is kind of like staying with me. And basically, I want to de-risk it all the time.
yep,
So if you are looking for 500,000 and I'm going to give you 200 and you still need the 300. So I don't want to send my money today because if you are not going to find the 300, I don't want to risk my money
yep,
because 200 is not enough.
yep,
This is generally the biggest misunderstanding. Like when we call it a round, it should be intentional. It's not about any random amount of money. So if you can do it with 200K, then you should do a round of 200K.
yep,
So anyway, most of the investors has the basically we can wait as long as we can.
yep,
We don't have an urgency at all.
yep,
So, uh, if you want to speed up the process, you create a competition, you create demand. So, what you say is like, hey, now we have like two more interests. This investor and this investor is kind of looking into our deal. Just let you know. And if they are going to be closer, I mean, what you need to do is like you play this same card to all of us. You say that Kaan is looking now, David is looking now, Andrea is looking now. So, because then if I feel that I might be out of the round, then I can say, okay, let me send it to you, Dave. Okay, like I can just send my money just to make sure that I have the subscription agreement, I'm in the cap table. Otherwise, I'm super happy to wait 2 more months. I mean,
yep,
obviously, we don't really put our money to interest accounts, but no, if you are going to fail in this 3 to 6 months, which also happened, by the way,
mm,
I've seen in my life that somebody was trying to raise capital, they got some part of the round and they failed in the fundraising stage because fundraising takes a lot of time and most of the founders kind of starts that process quite late in their time. Does it make sense? So you
yeah,
need to create this kind of FOMO between investors for sure. Or
yeah,
you give different incentive types. You can say that, hey man, this is a 500 round, K round, but if you come in here, you will get like a discount 20%. The reason why I'm saying this because now we want to hire someone to improve our like sales, whatever. Like you can always tell about the reason why you need the money the fastest, but it's kind of on the founder's shoulders.
Yeah, that makes perfect sense, and I've heard that a few times. I'm guessing that sometimes it's difficult. It's quite easy if you've got a couple of investors' interest, but if you don't have that and you genuinely don't, obviously you can't lie about it. So in that case, if you're the first person that they're coming to, is there anything that you can sort of ascertain from the pitch deck and the business and the market that makes you want to want to actually go for it now? Which, if there's no other investor interest?
I think it's really tough.
Yeah.
I mean, again, it goes back to my point on relationships. I
Okay.
mean, there were like three companies I sent my money. There was no company established. I sent the money to the founders because I knew them more than 1 year. And I
Okay.
knew them how they were like hustling, how they were like delivering. So when they said like, "Oh, we are starting something new and we need money because we want to establish it in US," blah blah blah, I said, "Okay, no problem." I sent money. I mean, it's not hundreds of thousands of dollars, but that happens. But if I don't know you, if I just knew you from like a angel investment network event, why would I care? Because the problem is like obviously as a founder, you think that you have the golden bullet, right? You are going to fucking do it. That company is going to be 100 million and power to
Yep.
you. I hope you will do it. But on the other side, there is someone every day receives that golden bullets and statistically sees that 90% of them were actually duds. It's nothing wrong with those people. So always, like an investor tries to keep the risk minimum. If I don't need to send the money today, I won't send it today.
Okay. Cool. Yeah. I mean, yeah, I totally get that. Okay.
Am I
So
a
we're
bad
nearly.
person, David? You
Sorry.
tell
Say
me.
again.
Am I a bad person?
No, no, not at all. No, not at all. This is what I'm hearing a lot. This is what I need to. My job is to get founders to sort of be match fit and
Yeah,
to have thick skins and to be prepared that this is a brutal process.
yes.
And like when you're asking for money, it is you're going to be under the most stress ever. But okay, so we're nearly at the end of this, and thank you so much for your time. Really, really appreciate your time, and it's been amazing talking to you. Is there anything just on a sort of ending note? Is there anything you absolutely like slap your head and go, "Oh my God, I can't believe I'm reading this thing again"? What's like the typical sort of classic killer piece of information that you see in a pitch deck that you just like makes you go, "Oh my God."
No, it's super funny because like literally you have seasonalities or like maybe like
Okay.
the business models of the year. Like in 2015, it was always about like marketplaces and social networks. And I would say like today, like 2, 3 years ago, a lot of the companies that we knew turned into NFTs and then they
Yep.
failed. They
Yep.
become like blockchain companies. And
Yep.
today I get to see like everybody's talking about AI,
Yep.
which is understandable. Like I also tell my founders to ride whatever wave there is, because
Hmm.
obviously you use those kind of technologies, but you just want to be sure that if you say that we are an AI company, at least have an AI engineer which knows data, like it shows, it really shows. Like you can always say that we utilize whatever is in the market, which is a good sign, but um, I really hate when people are saying that, oh, we have an opportunity to invest. That I don't know, maybe it's obviously English is not my first language. Maybe it's my problem, but whenever I see a LinkedIn message, oh, we have an opportunity for you to invest, I'm co-founder of this company. It's not
Yeah.
a fucking opportunity.
Yeah.
I mean, I'm super happy. Like, I like it. I know what you mean, but I don't really feel so lucky that receiving that message.
Yeah, 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 yeah.
Yeah,
So the cliches, the things that everyone
yeah,
uses, because you hear it millions of times. Yeah, I know. I
cringy
understand.
GPT messaging, I would say. Yeah,
Mm.
because I mean, this is how everybody's kind of trying to do it, but I think people should try to be more genuine,
Yep.
authentic, because the good thing is like a lot of the founders that I know, they are weirdos, including me.
Mm.
And you don't really want to see normal people,
Yep.
like with the text and the decks, because like whoever just goes thinking about like cybersecurity or like being a white hat hacker, like those kind of things. Like think about like most of the billionaires, they
Yeah.
are not normal,
Yeah.
which is good though. And those nerdy people just
Mm.
bring your like nerdy qualities just a little bit because I think that's important.
I love that advice. That's brilliant.
Okay,
Okay, thank you
cool.
so much. I really appreciate your time, and I hope you have a great rest of the day. And yeah, see you around soon.
Thank you.
Take care.